Now watch carefully. This is the moment when sheep becomes wolf and wolf becomes sheep.
After calculating the estimates from various orange-producing states, we have concluded the following. The cold winter has apparently not
At this moment, they knew they fucked up. Now you probably didn't make money by shorting SAP or banked on volatility with options. You are blaming Trump or whoever and trying to figure out should you sell or hold. Now, let me tell you immediately, you should hold even if you bought at the top, but if liquid enough, add to your open positions. You bought at the top because you didn't implement any strategy that works, so let me talk about approach you should use in my opinion. Minimizing risk and tilting odds in your favor in equity markets is imperative if one wants to generate alpha. Risk is subjective and hardly quantifiable. Still, when acquiring an asset class, be it real estate or equity, we know in advance approximately what returns we can expect. By paying the same money for business with 20% net margins will yield greater returns than one with 5. We could argue that it also depends how much real cash owner would take home about particular company cash flows because net income is not necessarily money that owner has in the bank on his checking account. But if the cash flow statements look akin, business with 20% net margin wins in terms of return. For equity markets, I consider earnings yield optimal choice for evaluation. Discounted cash flow analysis is largely used for evaluation in equities in finance world, but discount rate, growth rate, and all other variables are projected and estimated. Too much predicting and guessing take away from certainty and safety of the method. DDM model neglects real earnings power, but there is somewhat less predicting. But both DCF and DDM are unreliable in my opinion. Despite the fact that with earnings yield, you are using forward earnings yield to evaluate the stock, and there is still estimated variable in formula, only predicted thing is EPS, which analysts don't get too wrong. This is phenomena where most analysts are right about 50% of time about stock price target, so even monkey can beat them. But when it comes to estimated EPS, they are much more accurate. Studies have shown that their margin of error for developed markets is about 25% on average. In most cases, they are 25% more positive than they should be, which means we need to adjust analysts' earnings forecast down by about 25% to arrive at more accurate forecasts. Now, let me tell you, I personally think that you should buy stocks that are growing their earnings and also yield a good dividend. And one of those stocks is CFD Provider Plus 500. They are constantly growing their EPS and the net income, and also they are giving a great dividend yield. Now, you should consider that dividend per share for 2018 is 197 pounds, but 2019 and 20 are around 150. So we will take 150 divided by this current price. And we get 11% dividend yield. Now, look at this chart. From 2013, you could possibly make a huge amount of money if you bought them at 2013. But right now, this is also a great opportunity to capitalize after the markets rebound, and also you are getting that 11% dividend yield. Now, share price forecasts are also good. So basically, analysts are actually very, very positive even in current market environment. So most negative forecast is 18% down from this prices. Now, if you go to the Google and type into Google News, stock market news, you will get the headlines with panic, lower, ugly. These are the words that are currently used in the mainstream media. But don't be foolish and exploit current mispriced assets that are yielding huge dividends and are actually very cheap. Because if we are going to calculate the expected earnings yield for plus 500, we will take this number 174 divided by the current price, and we are getting 30% earnings yield. And that is very cheap for equity markets, especially for UK and America. Now, let me say again, you should exploit and take advantage of this opportunity. Don't sell, don't hold, add to your current positions, and also buy the stocks that are fundamentally undervalued, underappreciated, and they are yielding good dividend, they are having high earnings yield, and also they are growing their bottom line. This is all for today. Subscribe if you want to get notified about my new videos, and good luck with your investing.